In this discussion, we will discuss the discussion question of list and describe the basic assumptions of CVP, cost volume profit analysis. So there's going to be some basic kind of assumptions, and when you consider this type of question, if you see a question on these assumptions for the CVP analysis, you can also think about these are being kind of like weaknesses or arguments against the CVP analysis. Remember that every time we think about a CVP, cost volume profit analysis, we're not talking about generally accepted accounting principles. We're not talking about things that we just have to do. We're talking about a tool that we can decide to apply for decision-making purposes if we so choose. That tool having benefits, having things that are costs with it as well. And so there's going to be arguments for and against it. So when we think about the assumptions, when you hear assumptions in an essay question of the CVP, you also might be thinking in the back of your mind, these are things that are potential problems that we would have to argue for and then defend, basically give the assumptions as possible problems and then possibly defend the CVP against those types of assumptions that could be possible problems. So one of the assumptions is that we can break out everything between the fixed costs and variable costs. You'll note that if we talk about normal financial accounting, we don't do that. We break things out by what happens, what we're doing with the costs, meaning if it's for inventory, we put it into cost of goods sold. If that's the expense for inventory, we don't think about if it's fixed or variable so much. And if we're talking about selling expenses or administrative expenses, we break it out by what they do. With CVP analysis, we want to break it out by cost behavior. And that's difficult. That's not the easiest thing to do because we have those mixed costs that we have to make some assumption to break out between variable and the fixed portion. So that's the first thing we're going to have to do. And that it costs money for us to go through there and say, okay, let's break this off between variable and fixed because we're going to have to make some assumptions with costs that don't easily go between the two. And there could be arguments that there isn't a plausible way that, that we're kind of putting too much guesswork possibly into breaking things out between fixed and variable when it doesn't fit in a nice pattern between the fixed and variable costs. We're going to assume that the variable costs are going to basically remain constant per unit. In other words, as we have an increase in production levels, we're assuming that those costs that vary are going to go up in kind of a linear fashion. So we like straight lines in the CVP analysis. We want a straight increase in the variable costs. We want them to increase at constant rates so we can use the CVP analysis. We also, of course, assume that the fixed costs remain constant over a large period of time. As the costs go up over a large extended period, we're assuming that the fixed costs remain constant as well. In other words, they don't go up as the increase in level of production goes up. And we do the same type of assumption for sales. So when we make sales, we're thinking typically of selling like inventory or units usually is what we're considering. And we're thinking that the sales price is going to be the same. We have a constant price. And there's not a lot of variance in the selling price. In other words, sales should go up in a linear fashion as well. And you would think that would be the case if we're selling a product that basically increases in the same proportion with the same sales price. If we have multiple products, then we also consider a constant sales mix. So we have to consider the sales mix that is going to be made between those multiple products, and we need to have that constant sales mix because that's going to be what we can use in order to apply the CVP analysis. So you'll note that these are going to be assumptions and it's not a perfect world. So when you have a question like this, you first want to list the assumptions out as we've done here, then go through the potential problems possibly that these assumptions can cause, because people could argue that these assumptions are large enough that the tool of the CVP analysis isn't worth the cost of the implementation of the tool for future projections. And the argument there would be, of course, that the variance of what actually happens, there, of course, variable costs and fixed costs can't be broken out perfectly. There is, over some period of time, the fixed costs will vary at some point in time. They won't all be constant all the time. Variable costs will often have some kind of deviation from a straight linear type relationship, and we might change the sales price, and the sales mix might be something that we don't really know all the time. We might not know exactly what the sales mix will be if we have the multiple products. Arguments in favor of CVP against those would typically be saying that, hey, look, it's an estimate out into the future. The fact that it's not exact is just part of estimating. We're trying to project out into the future. We need a tool to do so. a numerical tool of, such as CVP analysis is the best we have. So we might as well break that out. It's a better type of analysis than anything else that we can basically do. It's too complex to use a standard type of income statement to break out, or it's a lot easier to break out the information using a CVP type of analysis. Even though, and another argument would be that even though there's deviations from a straight linear relationship between the variable costs and fixed costs, that the deviation hopefully is minor or immaterial or still small enough that the CVP analysis would still be effective. And it's possible that multiple minor deviations could actually cancel each other out by having them go in opposite directions and basically cancel each other out to be insignificant. Of course, they may not cancel each other out. Just that's kind of a statistical kind of argument. Possibly they cancel each other out. Possibly they possibly they don't. But if we have minor deviations, it's possible maybe they're minor in their first place, and possibly if they're going different directions, they cancel each other out. So those are some of the arguments that would counter the assumptions that might say that the CVP is no good. I think one of the strongest argument may well be that we need to forecast in the future some way. We need to make decisions in some way. A numerical process for making decisions is better and more accurate than anything else we basically have. And therefore, even though it's not perfect, even though we have assumptions, it's usually typically thought of as a good tool to apply if we have the cost-benefit analysis, if it's worth the cost to gather the information to do so.